everyone, and Happy New Year to our clients, friends, and colleagues. I'm Megan Trask, Director of our Investment Committee, and I'm joined by our Assistant Director, John Shanley. Our game plan for today is to talk about stocks and bonds, how they fared in 2021, and what's top of mind as we move forward here in 2022. I'm going to let John kick us off. Mr. Shanley, how did stocks fare in 2021?
2021 was a remarkable year for U.S. equity markets, really no matter where you were, in truth, right? Large cap stocks, small cap stocks, growth stocks, value stocks. We saw really strong market performance throughout. S&P 500 was up almost 29% last year.
Unbelievable.
When we were sitting here last year at this time, could we have imagined 29%? It's remarkable, truly remarkable. But what we also love to see is that that growth in the market was supported by earnings growth. So we saw companies grow in the S&P 500 last year by 32%. So really strong performance by U.S. companies and consumers, right? We're spending money. Companies are continuing to make new products and innovate, and we can participate in that as investors. Now, markets, like we always say, are varied, right? The S&P 500 isn't the only thing we invest in for clients. We do look for opportunities in things like growth companies and value companies. One of the changes that we had made to our portfolio last year was actually reducing some of our growth exposure and putting that into more value type stocks. That position and that change was looking long term. And if we're truthful, right, it didn't work out perfectly in 2021. Value still did well, but growth did a little bit better. We are, 3 weeks into the new year, and that narrative has switched a little bit, and value has actually been very additive to the portfolio. So you hear this from us all the time, but diversification is such a key tenet. We are not going to pretend we can predict exactly what part of the markets are going to outperform every single year. We do make some adjustments, right, when we see some economic data to support it, but we're always going to stay diversified. The only other thing, too, that comes to mind, Megan, when we think about the stock market last year is real estate, right? We added real estate in December of 2020, seems like decades ago, and that position has done incredibly well. We've seen real estate, commercial real estate, rebound incredibly strong over these last 12 months here. And then the kind of last thing I'll leave with when we think about the stock market, we have annualized 26% in the S&P 500 over the last 3 years. And think about all that we've lived through, right? COVID, presidential elections. There's hundreds of different headlines we can think about over these last couple of years. But for being patient, diversified, the stock market has rewarded us.
Absolutely. And I think as we sit here again and look ahead, one thing we would encourage folks to have top of mind is, last year was abnormal in terms of that lack of volatility, Absolutely. Right? We saw, I think, a 4% decline at some point during the year. The average year, we see a 14% decline. So we have a tendency to have recency bias, right? And think that last year, that lack of volatility is normal, when really it's not. And we should expect some heightened volatility as we move into 2022.
It's such a great point, Megan. And we see that here first 3 weeks of the year. I think markets are down about 4%. I think for some of us, it feels like it's more just because it has been such a smooth environment. But I think your point is such an important one. Volatility is just the price we pay to achieve these long-term returns. So again, stock market returns really strong. Megan, on the flip side, bonds, not as exciting, but tell us a little bit about what happened with bonds in 2021.
Yeah, John got to have all the fun talking about stocks, but equally important, maybe not as fun, the bond side. So fixed income had a tough year in 2021. If we look at the aggregate U.S. bond market, it was down about 1.5%. That's rare. Bonds don't typically have down years. However, it really wasn't a total surprise. The economic backdrop, the interest rate environment gave us some clues that it was going to be a challenging year for fixed income. Now, the good news is that we had made some tactical moves in the portfolio in the end of 2020 and in 2021 to better position our fixed income holdings for that type of environment. And our bonds, outperformed the index significantly. So our bonds were actually up about 0.5% in 2021. There really aren't a ton of tactical moves that we can make in the fixed income side of our portfolio from here without sacrificing quality. So it really, as again we look ahead, it really comes down to that top level asset allocation decision. What's the right mix of stocks and bonds in general for each specific client depending on their needs? These are conversations you can expect to have in meetings with your advisors and that we'll be having behind the scenes on your behalf based on the needs you have from your portfolio, based on your risk tolerance historically. That's really going to be the most relevant question when it comes to your fixed income holdings in the portfolio as we look ahead. While we wish we had a crystal ball to predict exactly what will happen in 2022, we sadly do not. And again, while we don't, we do have confidence in our investment approach that's deeply rooted in our financial planning work. That's going to result in a portfolio construction and design designed to meet your needs and designed to weather through any market condition. So with that, cheers to the new year. Thank you for joining us today. And if you have any questions or thoughts, please feel free to reach out to your advisory team.
Take care.